Good morning once again. Welcome to all to the session. Uh, Today also we'll continue the rules of debit and credit. This is the third session in this series. So we'll finish with this session. We'll finish the rules of debit and credit. We'll go to the slide. Okay. So yesterday we have done some journal debit and credit. Both the method we applied, the method of traditional and modern approach you understood. Now onwards, today onwards, we'll stick on the modern approach. That means I hope you understood the traditional and modern, both the rules. Now we will apply only one rule, one approach. That means it is better modern approach. But at the same time, you keep in your mind how to define debit and credit under the traditional approach also. So we'll continue the topic. So this is one set of transaction is given. The owner invested Omar 35,000. 35,000 real the owner invested in the business. So two accounts, as you know, it is cash. Two accounts is there will not be any change in any approach. Cash and capital. Capital account is the personal account of the owner. Owner is the giver. Credit the giver. Giver is capital. So that is different. But here we class of account we have to check whether the 5 groups. Remember, now onwards we don't have 3 groups. We have only 5 groups. That means we are following the modern approach. The traditional approach, it's over. By last class, it's over. Because both the method you are applying at the same time, it may confuse you. So 5 accounts, you know already: asset, expenses, liabilities, equity, and revenue. Assets and expenses, when increasing, it will be debited. When decreasing, it will be credited. Liabilities, equity, and revenue, increase means credit, decrease means debit. So cash is an asset. So class of account, you know already, cash is an asset. Capital, it is equity or capital. You can write equity or capital is the group. Equity or capital you can write. Then now increase or decrease. Whether increase or decrease, you can decide whether increase or decrease by connecting the transaction. The owner invested 35,000. Owner brings 35,000 and invest in business. So it will increase. Your asset or cash will increase. And your capital or your Rasulman, that also will increase. So asset increase, we discussed already. Asset or expenses increase means debit. Then we know already capital or equity increase. That means liabilities, equity, and revenue increase means credit. So you got this debit and credit. It means it is correct. Then now the next one you have to understand. Next transaction is with 3 accounts. I told in the beginning, minimum there will be 2 accounts. It may be 3 or 4, maximum 4 or 5 may be there in some in advanced cases. But normal case for diploma students and all, maximum it will be most often maximum it will be 3, minimum 2. 2 accounts should be there, 1 debit and 1 credit. So now purchase the van. You are purchasing a van for 20,000 real and paid 12,000 in cash and the balance on account. So you have to remember first, when you purchase a van, your asset or van account will be debited. We discussed the first in this series, in the first session of rules of debit and credit. When you purchase goods, debit purchases. When you sell goods, credit sales. In other all cases, when you purchase any asset, land, building, premises, vehicle, furniture, fixtures, any asset if you buy, debit the asset account, except goods. When goods is purchased, debit purchase account. So here, van is the one account is van. Van is an asset. Then another account is cash. And third account is, because 20,000 you purchased van, but 12,000 you paid immediately. So cash is going out 12,000, but the rest of the amount you will pay after the balance on account. That means after maybe 1 month or 2 months, according to the terms of credit between you and the supplier. According to that, it will be maybe 1 month or 15 days, 2 months, 6 months, up to 6 months it may be there. So that is doesn't matter. Whatever it may be, you paid now 12,000, and the rest of the amount you have to pay later. It means it is your liability. It is normally it is called account payable. Account payable. Whenever you purchase goods and money is not paid, it is account payable. Whenever you sold goods, money is not received, it is account receivable. That is you have to understand always. So three accounts are: one van, one cash. One van is an asset, cash is an asset, account payable is a liability. So van is an asset and cash also is an asset, and it is a liability. Account payable. Account payable means your suppliers, your mas'uliya, you have to pay money. So account payable is a liability. So you understood now. Now when you buy van, your asset or van increases. When you pay cash, your asset or cash decreases. When you didn't pay money, full money, some money you have to pay, your liability increases. So once again, asset increases, your van is increased, your cash is decreased, and your account payable liability is increased. Your mas'uliyat or liability is increasing. Now asset is increasing, you know, it is debit, and asset is decreasing, it is, you know, it is credit, and liability is increasing means also credit. So from this you have to understand, here the amount is also normal case, here debit and credit the same 35,000 you have to write, but here the amount also will be different. You can write the amount also here. Here it will be 20,000, and here it will be 12,000, and here it will be minus less. It is minus means asset decreases 12,000, cash decreases, and liability increases 8,000. So this is the position. But here it is okay, it is no problem, 35,000. Okay, we'll practice writing the amount also, so that you can you will not get confused when you are writing journal. So this is nothing. When the normal entry, simple entry, that means one debit and credit, there is no problem. Here you have to understand, 20,000 you purchased van, 12,000 you paid money, so cash decreases, and your liability increases 8,000, the rest of the amount. So we'll go to the next one. Performed service on account. You performed service or sale of goods or service, whatever it may be, it is your income. So you performed service and on account, but money has not received. Service has performed and money has not received. So two accounts are, one is cash is not coming in this because money has not received. Service already provided. So your two accounts are whenever you sold goods or provided service, but benefit or money has not received, there will be account receivable. It is called account receivable. This is very important. When you when you purchased goods and money is not paid, it is account payable. When you provide a service or when you sold goods but money has not received, it is account receivable. And another is not cash, it is revenue. Revenue means here service revenue, so you can write revenue. Sales revenue, it is service revenue. Two revenues are there. Here it is service revenue. If you want, you can write clearly service. It means, because if you want to distinguish this service revenue, it is separate. Service revenue and account receivable. Once again, you performed service, you provided service, but money has not received. So two accounts are, one is account receivable, it is your asset or it is your madin. It means you will get money in future. Maybe after 1 month you will get. And another is sales revenue, that means dakhal. Whenever you provided service means it is, already accrual recognition. That means accrual concept or income recognition concept. According to that, what is that? Income is recognized. According to accrual concept, income is recognized or accounted when service is provided or sale is made. So here you have made already, sale is already provided, so income you have recognized. Now account receivable, as you know, it is sundry debtor, okay, or account receivable is an asset, and service revenue is an income, or revenue is same term you can use, revenue or income. Revenue. Then asset, whether increase or decrease. When you provided service and money has not received, your debtors or asset or your your account receivable increases. So your asset increases and your revenue, dakhal or service revenue also increases because you will get the money later. So asset increase means debit and revenue increase means credit. Revenue increase means credit. That is according to the rule. We are not at all thinking about traditional approach now. Only we have to think about the modern approach. So modern approach is most often it is ACC is suggesting modern approach. Nowhere it is in your material, it is their service, the traditional approach. But at the same time, you have to understand it. That is why we discussed. Because some student will find it easy. Debit the receiver, credit the giver, like that. Debit what comes in, what goes out. Debit all expenses and losses, credit all incomes and gains. That three rules. Sometimes you will find it easy, but here onwards will not use that. Paid 500 for rent. You are paying rent. Whenever you paid rent, one account is rent and other account is cash, because cash is paid, cash is gone. So rent is, already rent is an income, rent is paid. If rent received, it is an income. Rent paid is an expense, and cash is an asset. Cash is an asset. Now expense increases whenever you made payment. Dafa, your expense is increasing, so expense increases, and your cash or asset decreases whenever you are making a payment, masruf or nafqat. You find any type of expense, your cash position or payment is made, your cash position decreases, so minus. Now expense increase means debit, already. Asset or expense increase means debit, decrease means credit. Cash or asset decrease, expense or asset decrease means credit. So this is the rule. Rule is very clear now. Then another here, paid remaining balance for the van bought on 5th April. In this question, on 5th April you bought the van, you paid 12,000. Here in this amount is not given, so you have to check the account on 5th April. This is 5th April. 20,000 you bought a van and 12,000 you paid. Now 8,000 you have to pay. Here the balance amount, remaining balance the remaining balance you paid. So the amount will be 8,000. So some question, some transaction amount will not be given, but the date will be mentioned. So you have to check the respective transaction. So paid the remaining balance for the board. Whenever payment is there, now the payment, there is some difference in payment. One thing is cash is decreasing. One item is cash is decreasing, that you know already. But the here remaining balance, to whom you are making payment, to a creditor or account payable. So account payable and cash, these are the two accounts. One account you are making payment when you purchased, at the time you see here, you can see on 5th when cash account payable, these 8,000 now you are paying. So at that time it is credited. Now when you are paying, it should be debited, it should be decreased. So that account payable, you have to write here account payable or liability. Liability is one account is liability, and another account liability, another account is cash. Cash is an asset. Cash, you know already, it is an asset. So liability, what happened? Before you bought 20,000 real worth of van and 12,000 you paid immediately. Now you have a liability, must only 8,000 you have to pay. Now you paid it. So your liability decreases. And your asset or cash goes down. Your cash is also decreasing. So when liability decreasing, we know already liability, equity and revenue. When increase credit, decrease means debit. And your cash decrease means always credit. Cash and expense increase means debit, decrease means credit. So these are the type of transaction. We'll go. I hope you can follow this, or you just once again, because this explanation is very important. Not just doing. You have to explain. You have to understand why it is debited, why it is credited. So 2-3 times, if you go through, you will understand clearly. So now received cash or 5,000 for service provided on 10th April. 10th April you provide a service, now you are getting money. So the amount is already 10th April. If you want, you can check 10th April. You service, you provided service, performed service on account. That means money has not received. So here account receivable is the service. Service already you identified, recognized. Service revenue, your income is already accounted or recognized. No need to touch your income. Now there only your what is that, 5th April. It is one is service, no, 10th April, service revenue and account receivable. So now that account receivable should decrease. So received cash. So cash, one account is cash and one account is account receivable. Account receivable. Now you have to understand cash, you know already cash is an asset, and account receivable or sundry debtor or Mudin or Zabain, which is your asset. Now what happens? Now what happens? Asset increases or decreases. When cash is received, your cash increases. When cash is received from your account receivable, and account receivable is another asset. They have to give you 5,000, so they are considered as asset. Now they are given the money. So your asset, account receivable or debtors decreases. So another asset decreases. Now you understand it is asset increase means debit and asset decrease means credit. It is direct, both are assets. Then we'll go to the purchase supplies for OMR 7,000 on account. You purchase supplies, you supplies or material or any type of material supplies you purchased and on account, money has not paid. So you know already supplies are purchased, it is not goods, it is cannot be considered goods, so it is better to write supplies. But the business is, anywhere it is mentioned that business is dealing with stationery or supplies of office supplies, then the supply can be considered as goods and you can write purchase. Otherwise, supply is supplies only. That means a separate a stationery, or it may be office material or anything like that. Your main business is not dealing with supply. So supplies is an asset, and also or expense or supplies is an asset. Then it is purchase supplies for OMR 7,000. That means on account. On account means you didn't make payment. So you know already it is account payable. Account payable. So one account is supplies, account payable. Supplies you can treat as an expense or it can be an asset. So it suppose it is an expense. Expense you can treat as an expense. And account payable is always, you know already, money is to be paid. Liability. It is liability is another. Then supplies and expense. Now you see your when you purchase supplies, your expense is increasing. You have to pay the money later. So your expense has increased. You have to pay the money. It is your mas'uliyah also, but you didn't pay. So your liability also increases. Now expense increases debit, liability increases credit. It is liability increases credit. Now you paid electricity 250 real electricity amount you paid. So two accounts are, one is expense, that means electricity, and another is cash. So cash and electricity, these are the two accounts. Cash and electricity. Electricity, you know, it is an expense. Cash, you know, it is an asset. Cash is always an asset. Now, whenever you make payment, your expense is increasing. So expense increases, and as it is made nakdan, immediate payment, cash. So your cash decreases. Now expense increase means debit. Asset or cash decrease or asset decrease means debit. Credit. Asset decrease means credit. You know already, asset and expenses increase means debit, decrease means credit. First, when you there may be a small confusion when you are doing first time, and after that you a lot of transaction you will be today itself. Today, if you do, we have around more than 25 or more than 20 transaction. If you do all this transaction, you will get a clear idea about the rules, especially modern approach. Now paid 7,000 for supplies bought on 25th April. 25th April you bought supply. Here it is supply 7,000 real. Now you paid the amount. When supply you paid the amount. One is cash. Cash is going out. So credit is cash. That is, you can write first. And another is, it is when you purchase supply and money is not paid, it is your liability. That means account payable. Account payable. Account payable is your liability. So your liability. And the other one, cash, is, as you know, it is an asset. Cash is your asset. Now, when you paid money, you have a supplier, you have a creditor, you have liability, you have account payable, or you have money, you are obliged, or you have debts and your debts, outside debt, dues and obligation towards this. Now you pay that. So your liability or mas'uliyah decreases. Then your cash also decreases. Now your liability decreases, you know already. liability, equity, and revenue. Increase means credit, decrease means debit. You can apply the rule. You should be always you have to by heart. Then cash asset decreases means it always asset increase means debit, asset decrease means credit. Then another thing you have to understand, if there is, I told you in the beginning, if there is two debit you are getting after your interpretation of debit and credit transaction, if you are getting two debit or two credit, it means it is mistake. You have done mistake, you can redefine and you can review and get the correct definition or correct interpretation. You will get the correct debit and credit. So these are the one set of transaction we have done. So next set of transaction little that means little more confusing. There may be chances of confusion, but try to understand it very clearly. This is also normal transaction, but still there are some three accounts are there. Some transactions are you have to think well, but you try to go through this 2-3 times. You watch and observe. And after that, you redefine or you make the draft of the transaction and you think and you make your own words. Then you will understand. Also, this transaction, and I will give you another after this completion of this, what do you call this course. Maybe 10-15 classes we will complete almost the major area of the course. This is today, I think it is a 7th session. So 5-6 or maybe a 15 session we can complete the entire course. So after that we will have in each course I will give some exercise and I will show you how to example. I will show you and I will attach in the video. I will attach that. You can do that. You can practice. Now, Mr. Hilal started business by investing 100,000 cash. You know already. Two accounts are cash and capital. Whoever start business, whether it is Zahran or Hilal or Fatma or anyone, it will be two accounts are cash and capital. So now tell me, cash is an asset. You can little fast you can do. Cash is an asset and capital is a equity or capital. Both are same. You can write equity. Most often that group. That means we are calling equity, liability, equity, and revenue. Equity or capital, revenue or income. But the best term is liability, equity, and revenue. So equity, so asset. When Hilal started business, he bring money to the business, so his cash increases. Whenever asset increases, it will be debit. And whenever your capital or your what do you call investment, is small. Or Rasulmal capital increases, it will be credit, because you know already the capital first you understand capital increases, so it will be credit because you bring the business money, you invest money in the business means you are giving money to businessmen, right? So your equity, your rights in the business, your right in the assets of the business increases. That is equity. Or your Rasul Mal or capital investment increases. So equity increase means credit. Now Hilal purchased computer by cash. Hilal is purchasing a computer by cash. Purchased computer and paid cash. So two accounts are, one is computer and second is cash. So cash and computer, these two accounts are cash and computer. So now tell me, computer, when you purchase computer is an asset. First you write computer is an asset. Cash is also an asset. Now you tell me, when you purchase computer, your asset or computer increases. But when you make payment, the cash decreases. So now tell me, when asset increase means debit, you know already, and asset decrease means credit. So that you understood. Now company purchased a car on credit from Suhail Bhavan Automobiles for 5,000 Riyal. You buy a car from Suhail Bhavan for 5,000 Riyal. So two accounts are First, you have to understand, whenever you see purchase, don't debit purchase account. Whenever goods are purchased, purchase account will be debited. Otherwise, car or machine or furniture, fixtures, land, building, premises, vehicle, akarat, or real estate, whatever it may be, the respective asset account will be debited. So here, car, and second is Suhail Bhavan. The name of the, normally if the name is not given, we'll write accounts payable. Otherwise, I told you, in tally and all, we have to write Suhail Bhavan. The account name is needed, but as you see a pattern, as you see outcome, name is not used, it is given account payable. So it is better we treat this account payable, even though name is there. Even though name is there, we can write account payable. But you have to understand, in some other cases, you have to write debit card, credit account payable. In place of account payable, you have to write the name of the supplier. That means Suhail Bhavan. Now car is, you know already, it is an asset. And account payable, as you know, it is a liability. It is a liability. Then asset. When you purchase car is increasing, your asset is increasing, and you didn't make payment, so your mas'uliyat or liability is also increasing. Now asset increase means debit, liability increase means it is very clear, it is credit. There is no any, because now we are applying the modern rule only, so you will get a clear by these two set of questions. So two set of transaction by doing, you will get a ultimate or clear idea. You can try any type of journal entries. Next class, I will show you how to make journal from this debit credit. It's very easy. You have to put debit first, debit, then second credit, and the amount you have to write, date you have to write, and small description from the narration you have to write. Narration is a small description about the journal. It is you can write purchase goods on car here. So it's very easy. But the deciding debit and credit, this is the most important task for almost all diploma students. If you are very good in this deciding debit and credit, or applying the application of rule, then you will be good in other areas of accounting when you go ahead. So the business paid for insurance covering full year OMR 600. This is two type of insurance you can. Business paid insurance. Two accounts are insurance and cash. Here the problem is business paid insurance for the full year. This is April only. Maybe from Jan to December, the accounting calendar you are following calendar year, it is January to December. So full year, this full year, what insurance premium you are paying 600 riyal. So you have to make it is prepaid insurance. Insurance paid in advance. It is an advance, muqaddam. So otherwise, if it is just insurance paid, the business paid insurance 600, you have to write first insurance and cash. So in this case, you have to write prepaid insurance and cash, because cash is going out. So cash and prepaid insurance, you can write two accounts. Now prepaid insurance, you have to understand, insurance only, it is an expense. But prepaid insurance, if the insurance is paid in advance, muqaddam, it is your asset, current asset. So you write current, no need to write current or fixed, it is asset. In the rules, there is no current. You have to understand it current asset, but when you are applying for application of rule, we need whether 5 groups: asset, expense, liabilities, equity, revenue. There is no need to classify current and fixed or non-current. So asset and cash is also an asset. Now you define here, when business paid, that means insurance is paid for the entire year, your asset That means if it is considered as an asset, prepaid insurance, it is increasing, but your cash is decreasing because cash is going out. So credit what goes out. So you have to credit cash. In that traditional, sometimes you can, if you find it is very easy, you can apply the tradition also. But asset increase means debit according to new rule, according to the modern approach. Asset decrease means credit. So now I think you can understand this. Hilal provided accounting service to customers by collecting cash OMR 1,500. 1,500 Riyal. Hilal provided accounting service to customers by collecting 1,500. You collected money and provided service. It is not on credit. Another we have before we discussed one case, provided service on account. Money has not received. So here it is cash and revenue, service revenue or revenue. So service revenue, I told you, sales revenue and service revenue you can distinguish. So here service, that will be good for analysis later. It will be helpful for you. Sales revenue, service revenue, you keep. Sales revenue means what is that? Yeah, the revenue from sale of goods. The other one, revenue from providing service. Some companies, some organizations may be doing both, sale of goods and service. So in some, if if it is only service, your company is providing only service, transport service, insurance, warehousing, advertising, like any banking or any service only, revenue is enough. It means service revenue. But some undertaking, for example, your electronic appliance, sometimes they make maintenance and repairs or electrification, and also they supply the electrical goods or appliances. So they have to understand how much they got income from sale of service, sale of product, sale of goods, and how much income from sale of service separately. In that case, especially in you are applying the software, like I told you, Tally, QuickBook, SAP or ERP, any software, you have to distinguish these. You have to, because it will go to the different account. So always when it is service, you can try to write service revenue. Or if it is a sales, you can write sales revenue. If it is a sales, you can write sales no. Sales and service revenue. Sales revenue or sales revenue and service revenue. Now, Hilal provided service to customer by collecting. He collected money, so asset comes to the business, asset, and service is income or it is a revenue. Service is revenue or income. Now you can check whether asset increase or decrease. Asset increases or decreases. So you are getting money. So asset or cash is increasing, and service is also income. Your income, or what you call khidma, income, dakhal, that is also increasing. So service revenue also increase. Asset increase means debit. Service or revenue increase means credit. You know the second part of the rule. Liability, equity, and revenue. When increases, it will be credit. Decreases, it will be debit. So these are the things. Now we'll go to the next one. Next one is business offered service to customer 700 on credit. You are providing service to customer for 100 Riyal on credit. Provided service, not received money. So if any customer, you sold goods or provided service, not getting money, it is account receivable. So account receivable, or it can be called sundry debtors. So normally we write in here in I told you two way. In Tally we are using sundry debtors, account receivable of sundry debtors, or customer name will write. But in our outcome it is called account receivable. So we will go according to our outcome. Then it is account receivable. Now service revenue is also is there. Service revenue, it is an income. Always it is credit. Service revenue. Now you tell me account receivable is an asset. You know already. Service revenue is a revenue or income. So whenever you provide service and money has not received, your account receivable or your customer or your asset, because he will give money later, so that asset increases. That means increase, and your revenue, your service revenue also increases. Your revenue also increases. Now, asset increase means already it is debit, and revenue increase means credit. Already this is liability, equity, and revenue. When increase, it will be credit. Decrease, it will be debit. Now, next one is the company paid OMR 500 to Suhail Bhavan. Now, Suhail Bhavan, you are paying money to Suhail Bhavan. So, who is your Suhail Bhavan? Account payable or sundry creditor. That means your liability. So, account payable or Suhail Bhavan you can write, and you are paying cash. So, now tell me, account payable is a liability, and cash is an asset. Cash is an asset. Cash is an asset. Now tell me whether your Suhail Bhavan, you have to pay money. It is your liability. Now you are Masulia, but you pay money, so your liability goes down, decreases, and your cash is also going out. It is decreases. The fact. So liability decrease. Already liability, equity, and revenue increase means debit, decrease means credit, and cash or asset decrease means company paid Suhail Bhavan, your account payable liability decreases. Yes, here mistake. Once again, I'll tell you the rule. Sometimes this confused. Check it, because if it is coming to credit or to debit, you have to think well. So liability decrease means, once again, liability, equity, because it is, you can write in your paper a small table, you can make that rule. Liability, equity, and revenue. When increase, it is credit. When decrease, it is debit. You see, otherwise you will get two debit. Then asset decrease means credit. Otherwise you will get two credit. Two credit never come. So that also you have to understand. Sometimes when you are doing fast, you may get mistake. So how you know? Two debit? No, never. Two credit? Never. So you have to think again. So now I made here liability decrease is a credit aspect, and asset decrease is also credit, but I didn't write because it never comes. So it may happen, but before finalizing, you have to think and you have to correct. So once again, liability decreases debit, asset decreases credit. Now the next one is the company collected 500 from customer who previously billed the service for on credit. Previously billed, billing is over. Previously, income is recognized previously. Don't take it as income again. It is already recognized. Now you are getting money. It is a customer. The company collected customer. So account receivable and cash. Account receivable and cash. These are the two accounts. So account receivable, because you provided service before it is, if you check, you will see that entry. You provided service, because you can check, date is not given. You can check provided service. Here it is, company paid now. 5,000. No, here it is. Sometimes it may not be there, but you can, if it is in the right order, if you want to trial balance, in that case the continuity will be there. So this is one transaction you provided long time before. In earlier transaction, earlier question, maybe service provided. At that time, what you have written? Account receivable and revenue, service revenue. Now again, account receivable is coming. Account receivable, they are giving money. So account receivable and cash. So account receivable, as you know, it is an asset. Cash, as you know, it is an asset. Now here you have to be very careful. Now the account receivable, he is a debtor, account receivable, Mudin, or your debtor. He give you money. Debtor is an asset. He give money now, so debtor decreases. That means it is decreasing. Now your cash is increasing because you are receiving money. You receive money from a debtor long before you provide service. Now you receive money, so your cash increases. Now asset decrease means credit, and asset increase means debit. That's no mistake. As debit and credit, if you are getting, but if you get, I told you, if you are getting two debit or two credit, you have to translate or interpret again the transaction. Now the business received monthly utility 100 real. Mr. Hilal paid 50 and remaining amount deferred to next month. This is a 3 compound journal entry. It means you received a bill, utility, expense. So first it is an expense, utility is an expense. First you have to understand this utility is it is an expense. Normally water, electricity, gas, energy, this all type of things are expenses, not telephone or rent, wages, commission, like that. This type of your energy for your spending, for your motive power or energy, like electricity, water, gas, and power, this all coming under utility expense. So utility is an expense, sum total. So how much is this? You have, if there is a 3 that means triple compound entry, it is better to write the, I told you, you can write the amount also. So utility is an expense. First you make utility is an expense, and cash you paid out of 100 real, you got cash, you paid 50, and deferred means it is payment will be made next month, outstanding. So payment will be later, you will make the balance, not now. So it is a liability. So cash is there and you have the liability. One is cash. Cash, and another is account. Any amount you have to pay later, it is your account payable or your liability. So now cash is an asset, and account payable is a as you know, it is a liability. Account payable is a liability. Now what expense is your, whenever you make your expense become due, recognized, accrued, it is expense has increased. Now cash is paid, so your how much you paid, 50 real, and here you can write increase how much, because it is amount is different, 100, and here 50 real, and your liability increased. Your liability increased up to 50 because you have to pay this money later. So 100 real you made an expense, utility expense, you have incurred a utility expense, or it become due. Out of that 50 real you paid already, 50 real you paid already, minus 50, and 50 real you will pay later. 50 real you will pay later. Okay. 50 real you will pay later, minus 50 plus. So this is a 100 real you made an expense, 50 real you paid, this cash decreased, and all other 50 is your masuliya, liability. So now expense increase, you know already debit, and asset decrease, you know already credit, and liability increase, you know already credit. Now you can see one debit and two credit, but the amount is equal. I told you equal and corresponding. For every debit, there will be equal and corresponding credit. 100 real debit, one debit. But two credit is there, it doesn't matter, but total is 100. Total is 50 plus 50 is equal to 100. So this is called the accounting basic double entry accounting meaning. We discussed already principle. For every debit, there will be a corresponding, equal and corresponding credit. Amount is equal, two debits are there, but corresponding it comes. Total amount is same. So these are the transactions. Now we'll go to the next one. Three more transactions are there. So business paid salary for its staff. Salary staff salary is paid, salary and cash. Salary and cash. Salary, you know, it is an expense. And cash, you know, it is an asset. We have done a lot of cash. We have done. Cash is an asset. You know very well now. And expense, whenever you pay expense, your salary or any expense you meet, your expense increases, your cash decreases. Expense increase means it is a debit aspect, and cash and asset decrease means it is a credit aspect. There is no any confusion. It is a plain entry. And business paid rent OMR for the month of April. Now you paid rent. So two accounts are rent and cash. So rent is an expense, and cash is an asset. So now whenever you meet expense, your expense increasing, and whenever you make payment, your cash is or asset is decreasing. Expense increase means debit, and any asset decrease means it is a credit aspect. Now last one is Hilal withdrew cash 200 real from business for its personal use. Whenever you take money for money or goods or any asset, anything you take from the business for your personal use, khusus or khasa. Sahab mal, it is called sahab mal or drawings. So two accounts are one, drawings, and another is it is cash. If goods are taken, it will be purchase and drawings. If cash is taken, it is cash and drawings. Cash and drawings. So drawings is just considered as a payment of expense. Drawings can be entirely also drawing considered as a payment, or it can be an expense, just like an expense, and it is cash is an asset. So your expense is increasing whenever you make drawing. Your expense or also it can be interpreted in different way. Drawings may be a decrease in capital or equity also. So in the both way I will explain. So expense is increasing, and if cash is going out, so your cash or asset is decreasing. So expense is increasing means debit, and cash decrease means credit. Now you can hear another, it is also very valid what you call interpretation. You can make drawings is a part of equity, because whenever you make drawings, your equity or the capital decreases. But here equity will not increase, equity will decrease. That is very important. So when equity decreasing, you know already when equity is decreasing, what is the rule? Liability, equity, and revenue. When increasing, it will be debited. When increasing, it will be credited, and decreasing, it will be debited. So both the way, if you interpret in both the way, when drawings are considered as a part of equity or capital, or if you consider it's an expense or payment, just like you are doing in tally, both the case, the rule will be the ultimate result or debit or credit will be same. Here if it is an expense, expense increases. When an asset or expense increases, it is debit. If you consider it's a part of equity, when you take money for your personal use, your drawings, your capital decreases or equity decreases. So equity decrease means debit, and cash decrease means it is always credit. So both the way you will get the debit aspect. So this is the okay for today. We have done almost I think 30-35 around because it is 12 plus 12 for 24 plus 12, that means 36 entries I think. So you got a debit for understanding debit credit. So now I hope you understood the very important topic, debit credit. This topic, this is area of accounting, is from A to Z of accounting. This is, that means the application of rule or debit and credit or journal. This is journal itself. Journal is nothing but this. If you understand this, you put in the format, you write this, that is journal. You can write this first debit. For example, for example, this account you can write a simple entry will take debit salary, credit cash. The amount you have to write 750. Date you have to write, and you have to write paid salary. That's all. That is journal. Date, particulars, LF ledger folio you need not write. You just keep blank, and debit amount, credit amount. Both the side you will get 750. That is journal. So if you understand this, journal is nothing for you. So I hope you understood the topic, and this area will be, I expect it will be useful to you. And anyhow, thanks for watching the session. Thanks a lot.